Hi, this is Brett Senkis. I'm the owner of Senkis Law, which is a corporate transactional law firm, and Brayton Woods, which is an M&A advisor. We do business brokerage and we do M&A, mergers and acquisitions services. So we help market and sell companies. So I do that from the legal side in Senkis Law, and we do it from the investment banker, M&A advisor side in Brayton Woods. So today we're going to talk about an issue that comes up a lot with buyers and sellers in mergers and acquisitions, which is what do we do with the debt of a business when we're selling the business? Or if I'm buying a business and the business has debt, how is that handled? So in the Main Street part of the market, which is deals of less than $2 million in transaction value, and then the lower middle market. So I define all this as, say, $0 to $50 million. That's my Main Street lower middle market. The debt is almost always paid off. It's almost always paid off because it needs to be. And so if you're a seller and you owe more than the business is worth, you've got a problem on your hands. That's not unlike the difficulty you would have selling your house if you owed more than it was worth. There's a process there, it's called a short sale, but it's not easy to navigate in the real estate context, not easy to navigate in the business acquisition and sale context either. But let's assume there's some debt on the business, but it's not more than the business is worth. Well, typically the debt will have covenants, negative covenants, which basically a covenant is a promise to do or not do something in the future. It says you can't sell the business, you can't sell the assets of the business. There are these restrictive covenants that require you to get approval of the lender in order to make a fundamental change to the business, like changing most of its ownership or selling its stock, selling the asset. Most debt is going to have a provision like that. Certainly, almost every loan, even most commercial contracts you'll see out there have anti-assignment clauses, which say you can't assign this debt to another party, or you can't assign this contract or lease to another party. So in an asset sale, so where a business sells its assets, that's definitely a problem. Even in a stock sale, which isn't an assignment of assets, if I own a company and I sell you my stock, you just step into my shoes. All the assets and things of the company, nothing changed, just as a different person holding the equity. In that case, an anti-assignment clause that just says you can't assign the debt wouldn't prevent you from doing that deal. But most loan facilities, small business administration loans, those kind of things have a more fulsome change of control provision, what they call it. So you can't not only assign or sell all the assets, you can't assign this loan to anyone, you can't sell more than 50% of the equity in your company, you can't do a merger or reorganization. So again, the debt itself says you can't do these things without getting permission. Now, so what if you don't get permission? If it's secured debt, so if there's secured debt, is debt that has a lien on certain assets or collateral. It could be the equity interest in the business, it could be certain assets, it could be everything, what we call kitchen sink lien. Then not getting permission and changing over the ownership is really passing on a big problem to the new buyer. So if you're a buyer, this is a huge issue because the bank or lender could get wind of that, decide they're not really happy with what happened here, don't really want you as the party who's going to pay as opposed to the seller, and they could foreclose on the assets. It's a huge risk. If the loan is not secured, then they can still call the loan due, right? And if you are a buyer and you take over a loan, even if it's not secured, you don't want the lender to call it due because they have the cards and they can push on you and they can sue you. So this is a big problem for sellers. It's even a bigger problem for buyers. You want to make sure that if there's debt on the business, if you can take it over, either by structuring the deal in such a way that you don't trigger one of the negative covenants, or to get permission of the lender, and you're willing to take it over, that's fine, right? You got to deal with it that way and be very intentional, make sure you're not triggering the loan. If you can't do those things, and usually with these smaller deals, it's really not an option. So we just get the debt paid off at closing. And that's really important as the buyer. If you're not going to take it on, if you're not able and willing to take it on, you definitely have to have it paid off at closing. So as a buyer of a business, you want to be out there or have your lawyer looking for liens, looking for debt of the business. What exists right now? In Texas, the general blanket lien on assets are filed with the Secretary of State. I think that's the case in most states certainly most that I've seen. If it's real estate, it's filed with the county in Texas. That's also typical in most states. So you're looking to see what's out there. You're putting together in your purchase agreement representations that the seller has to make that will flesh out what's out there. So you'll say, there is no debt on the business except for these things. And if the seller misstates, you have a claim, a contractual claim against the seller. You can go back after them for an indemnification after the closing if you do that all right. But it's more important, in my book, sort of step one is just to be sure you know everything's out and you deal with it. So you do those lien searches. And then at the closing, ensure that the debt is paid off. So the way we do that is the attorneys typically act as escrow agents. If there's real estate involved, the title company may handle some of this, but you get a payoff letter from the current lender, get them to acknowledge if they have a lien, that they will release the lien immediately upon payoff. And they kind of do that as a matter of course and need to, but you still get it very clear that we're going to come back to you and have you actually physically, or send over the release of the lien to clear off the lien on the business and the assets as soon as you're paid. So we get these payoff letters, and a lot of times the buyer will actually make the payment or have one of the attorneys take the money and make the payment. You would trust most sellers of businesses to go take care of the debts if they said they were going to take care of them, but why even put the money in their hands, really? If I'm representing the buyer, I want to control this process and be sure this does not fall apart and that the liens are paid off or the debt is paid off and the business is clear, whether we're buying the assets or the stock. I'm not taking on the seller's problem. So that's how that's handled. There are different ways to do things. You could certainly approach the lender, try and negotiate something. There's lots of creativity, but generally speaking, in the mainstream, low, middle market part of the market, you get it paid off is what you do. So if you have questions about this, if you're a seller or buyer of a business and you want help on the legal side, or if you want help selling your business, reach out. Thanks.